Ladies and gentlemen of the crypto space, we're live on a Friday, June 30th at 11:36 a.m. Comfort in the markets. How do you find comfort in the markets? It's by looking at data and assessing where we are and where we could potentially head based on information that we have about now and based on speculation and probability about where we're going to head. So that word is called confluence. As you find additional pieces of data, you're able to build confluence suggesting that the future is going to head in one direction or another. Direction is binary. Things go up or things go down. Nothing in reality exists in a horizontal spectrum. You're either gaining weight or losing weight. You're either passing or failing. You're either on team A or team B. You either have an opinion of yes or no. Price goes up or down. The aggregate market actor, the culmination of every single individual, doesn't result in horizontal activity. So, where are we in markets? What do markets tell us? Now, something that I contemplate often is causality, cause and effect. Which creates which? Do the markets create political action, or does political action create markets? And obviously it goes both ways. But I find it quite interesting that when I look at data nowadays, I'm kind of seeing political decision. How did we get to where we are based on what decisions have been made? How do we see the data we currently see based on what we understand the process to be for politicians and regulators going forward? Like, what does the structure of the system need to be for the system to actually work? Let's pop it over to the main screen and look at the chart of the day. I posted about the dollar this morning. Now, obviously, let's talk this through. It's quite interesting because I firmly subscribe to what Brent Johnson talks about. And if the dollar goes up, 120s, 130s, 150s, 200s, there's no other foreign currency. It's done. It's gone. The whole world will become the dollar, and every other currency will be useless. So, from a political perspective, does the U.S. want to collapse every foreign fiat system around the world? And if so, that would have geopolitical implications. That would have global stability implications. That would have countless implications that I'm not even considering at the moment. And that would be maybe an act of financial war, which I guess we're starting to entertain with the activities that we've taken with Russia over the last year. So, what is the odds that we're going to head in that direction? If the dollar goes to 130, 140, 150, that means the yen and that means the euro are collapsing. And that means, sure, they could buy things euro denominated in Europe or yen denominated in Japan. But when it comes to anything that's priced in dollars, you're fucked. If you're at 102 and you go to 150, you don't have enough euros and yen to do anything. Your currency, the whole structure of the system becomes completely non-functional. Purchasing anything that requires dollars, they're just too expensive. So this is why Luke Groman talks about things being priced in non-dollars. Like Argentina paid back the IMF in yuan, which is interesting. But all of that stuff is marginal. Now, bear in mind, everything starts at the margins. Change starts at the margins. But the margins kind of indicate to us directionality. And that change, that end state that everyone thinks is like, oh, wow, they're dollarizing or they're paying back the IMF in yuan. That shit takes forever to play out. Everything in the world, traditional finance, legal, clerical processes takes forever. It's so slow. It's so infuriating. And this goes into what I've been talking about with my banking experience and the court order. And it's taken them over 5 weeks to respond to a U.S. judge court order. So first-hand experience with how fucking slow the whole system works, which is why crypto is so refreshing. It's instant. Instant. So I love this chart. This chart tells me very obvious things that 3 times in history, the U.S. was in a very difficult financial position because we have domestic affairs to consider, but internationally, ever since 71 especially, when everything was priced in dollars, and things are becoming less and less priced in dollars, and that trend will likely continue, but it's not stopping today. De-dollarization doesn't happen today. So sure, people will be able to purchase goods and services, commodities, natural resources, and other denominations because the dollar is a problem. The dollar is our currency, but it's the world's problem. So as much as we have a domestic agenda to have, decreasing consumer price inflation and regulators are acting accordingly, if we don't cater, at least to a degree, the rest of the world, because the whole world is priced in dollars, the vast majority of financial activity on the planet is denominated in dollars, then there is no imports. There is no international market. There is no international fiat. It's crushed because the countries are in the process of becoming um, unsustainable from a dollar-denominated perspective. So we cannot just sit back and let the dollar collapse the rest of the world. What does that mean? That means the whole system operates in cycles and pressures. And pressures, economic pressures, influence or have create political pressures. So clearly, what is the political pressure depicted by the behavior of the Fed and what is expressed by this chart? The political pressure is a bit of a contradiction. Politically, let me just make sure audio is strong this morning. I think it's good. Let me just check audio. Total left field. I just want to check audio real quick. Oh, goodness. Let me bump up audio. I should check these things more often. Sorry, guys. Okay, so politically, from a regulator perspective, domestically, the Federal Reserve has been increasing interest rates because they want to curtail credit expansion domestically in the U.S. such that there's less currency, and we see that on M2. M2 has come down. So this is a manifestation of their agenda to decrease available currency units inside the U.S. and that decreases financial activity, which decreases price increase pressures. So we see that expressed here, and obviously what we see on Fed balance sheet, reverse repo, Treasury general account is a manifestation of everything they need to do to finagle the financial system at this point. This chart didn't exist pre-08. It was non-significant. There was no balance sheet to this degree. So now what they're doing is intervening in markets, especially the reverse repo. What a absolute manipulator of the Treasury yield curve. Complete distortion. So this chart tells us the degree of intervention, but that's not overwhelmingly significant from what I like to look at. I like to look at, yes, M2, domestic, and international. I like to look at the concept of liquidity, and that tells me the most important thing about price action of markets, directionality up or down. And to me, as this goes up, obviously they're manipulating domestic liquidity up. So this is representative of the liquidity phenomena. And this is M2 is a trailing indicator of domestic liquidity. If anything, Fed balance sheet is a forward-looking indicator of domestic liquidity conditions. US M2 is a trailing indicator of domestic liquidity conditions. And the DXY, trailing or forward-looking? forward-looking indicator of international liquidity conditions. Okay, so this is maybe neutral to trailing. This move is the ultimate forward-looking indicator of international liquidity conditions. That is a big deal. So as this comes down, the international world has a capacity, an increased capacity to print dollar liabilities, and that increases total circulating supply of dollars. And when you have more dollars, you have more financial activity and more allocation of capital to speculate and invest, so on and so forth, and you have price appreciation. Liquidity basically tells you whether the market's going to go up or the market's going to go down. That's why I look at it. That's why I've reduced this entire equation of what the hell the market's going to do to these simple observations. Because my comfort comes from simplifying. As a reductionist, I want to reduce the system, the equation of the system, to the simplest possible uh, perspective of interpretation, and that's liquidity. And liquidity is an abstract concept. It basically means total aggregate amount of dollars available for financial activity. And that has no significance with regard to what actors are going to do. For instance, you could have significantly decreasing liquidity conditions and reallocation of capital from one market to another, which creates price appreciation. So that's concentration of capital. But overall, it's still a negative sum game. Decreasing liquidity conditions, decreasing currency units available that everyone's fighting over. So I have significant confluence suggesting politically they have chosen to allow the system to continue. Oh shit, what does that even mean? For the system to continue, you need foreign countries. You need foreign currencies. You need foreign supply chains because the whole nature of an economy, what it has become over the last decades, it's a global economy. You have international trade, you have financial activity cross-border, you have the buying and selling of natural resources across borders. You know, the U.S. is extremely reliant on itself, self-reliant with regard to availability of natural resources, but we are still dependent on many things from cross-border sources. Every country is. Why? Because that's what this reality is. There's minerals and resources scattered around the world, and different places have different things, and that's just the way it is. Now, obviously, human resources and employment, that's another story, but that's also the case. Different countries offer different types of human resources that have different types of expectations depending on respective financial conditions in the local market. Point being, it's a global world, and I don't think the U.S. is in a business of collapsing foreign currencies in 2023. So, at minimum, I would expect international liquidity conditions, as this forward-looking indicator suggests, to improve over the next 3 to 5 years. Internationally, they will have an increased capacity to print dollar liabilities, expanding liquidity conditions, improving financial activity. Now, the breadth to the upside might be diminished, meaning you're not getting as much bang for your buck because debt servicing on these dollar liabilities is increasing, so that's eating up capital potential, because now you have to allocate, your income, part of your income, to allowing this liquidity to remain in an expanded state. But this is a big one because as the dollar liabilities increase, the dollar denominated debt is still dollar denominated, which means as the dollar relatively becomes cheaper, it's easier to sustain the inflated state of the dollar liability system outside the U.S. So this is the ultimate confluence, in my opinion. If they regulate the dollar down, whether it's by like an international accord, which they've done in the past, or not, just because the U.S. chooses that foreign fiat can survive, because that's what it is. This chart down, and move down, Yeah, obviously in a 10, 15, 20-year time, you don't know what's going to play out, and the whole system is unsustainable. We understand that. But from a 3 to 5 year perspective, DXY down, move down, significant increase in dollar liabilities outside of the United States. And that's the bottom line. I like this chart of the DXY better. It shows us our levels. Well, actually, this chart, I got a complete mess with my charts. I got to fix it. I moved this chart, this green line, right to where it needs to be for today's close in 7 hours. This is what has me most excited today. I've been waiting 6 months for one candle, ladies and gentlemen. There's one tiny little candle over here. And this means everything right now to me with regard to my comfort level because candles matter. And this is a massive, massive shooting star on this 6 months chart for the DXY. The last time we saw a shooting star like this, 1985, all those years ago. If you zoom in, what happens? This is a magic line. This 103, 102,997. That was the top of the blow off top in January of 2020. It was invalidated back in 17 and earlier in 16. It was invalidated back in 2000. The region above 103 was invalidated. It broke above it and it failed to hold. It was invalidated back in 1981 and it took till 87. It took 6 years to invalidate the move above 103. And now, not, it was rejected obviously in 16 and 17, but now the move above 103 between January of 22 and current is in the process of being rejected. Obviously because of things like this, because of the artificial intervention and stuff of this nature and political choice, political decision, regulator decision. But that's what's occurring. And that was the point of the title. Does politics create charts or do charts tell us politics? So obviously politicians have a capacity to make choices and decisions that influence economics and will alter this chart. But if anything, political choice is like a tugboat on a supertanker. It takes time for these choices to filter through the system, much like regulators and increasing interest rates and suppressing domestic consumer price inflation. They say what, 12 to 6 to 18 months for interest rate hikes to filter through the system? Sure. Okay. Same with political choices and decisions. And sure, you have your social media response and things get jerky, the volatility goes all over the place. But what matters is the prevailing directionality. And that's how you find your comfort with these ridiculously volatile markets where people are literally just irrational and acting on, intent to capitalize. They're acting on short-term volatility to be capitalistic. It's understandable. Just peer through that bullshit. At least that's what I finally found the capacity to do by understanding these types of concepts that we've talked about in the stream today. Directionality. And volatility doesn't mean much unless it invalidates directionality. But directionality continues until capitulation. When you have a directionality reversal, it doesn't just spontaneously continue back in the directionality of capitulation. Look at this fucking chart. This is the most ridiculous capitulation candle on this chart since 1985. This shooting star is a beast, suggesting directionality reversal. And this shooting star is consistent with the move blow off top. So what does that mean? So let's explain what this dollar candle means. Dollar demand was through the roof. It was so strong, it was starting to explode. And how in the world could dollar demand decline? Aside from like contracting financial activity and significant declining demand for natural resources. Dollar availability. International actors that needed dollars were able to acquire dollars from alternative sources other than this FX market. That's the only way you could possibly get such a sharp decline in dollar requirements. Otherwise, markets act cyclically. They're not, instant responders. This is a bit of an artificial reduction in dollar demand because the dollars were just found from another source. That is what causes that relatively instantaneous response. And relatively instantaneous, as depicted by this chart, is a 6-month time period. So this indicates that volatility was a blow off top. The world wasn't using U.S. treasuries to create dollars. You can't with a blow off top like that. It's too volatile. The uncertainty, actors are like, I'm not going to touch this shit. I'm not going to print dollars using these treasuries. But this entire period from March of 22, this is what, a year and change? How many candles is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 18 months. This is a rounding top. There's no breadth to the upside. There's no suggestion of continuation. There's a giant shooting star. And that shooting star had an inverted hammer. This is on the monthly. That inverted hammer could have been suggestive of lack of continuation to the downside. To top it all off, there was a double inverted hammer. Top it all off, a double inverted hammer. That just screams, oh, there's support. This thing's going to go back up. That's crazy. So this chart is actually crazy from a candle perspective. The shooting star, indicative of reversal. Double inverted hammer, indicative of invalidation of that reversal indicator. Then the break to the downside. 5 hours left for the monthly close, a close below the monthly TWAP. Time weighted average price on the monthly. Now what we're looking for is another close below the TWAP. And dare we get a close below the close of this candle. This candle looks like it's going to close around 113.4. If we get a close next month of 113.2, 113.1, 113, that is how you build confluence from a candle perspective. Let's take a look at the 6-month chart here. Not as interesting, particularly because the TWAP is so far below. And you don't have enough data, really. I'd say about the monthly, maybe the 3-month. 3-month. 3-month chart's interesting. Look at that, the 10 SMA. Looks as support for both the last 3-month cycle and this current 3-month cycle with closes in 5 hours. Which is very interesting, which means now we need further confluence. We need to see this break down, and I'll go back to the monthly chart because you want to see it close at a lower low and lower low, lower high, lower low for directionality continuation. So we look for signs indicating continuation of directionality. I don't think we're going to have invalidation of the directionality change suggested by this remarkable shooting star in March of 23. The March of this year. And frankly, if you close, this is an interesting region. Look at this region. Look at this region. It's a very interesting region over here, give or take. That's a region of resistance. Look, invalidate, 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 invalidate with an 18-month rounding top. So what does this mean? This means bond market volatility cyclically falls through the floor. Dating back, well, this chart only goes back to 2003, but that's significant. It's recent history. So cyclically, bond market volatility will be suppressed either artificially or organically, and that will facilitate the printing of dollar liabilities outside of the U.S., which will allow the DXY FX dollars to significantly come down, producing confluence that there's increasing dollar liquidity conditions outside of the U.S., and that allows the world to stabilize from a financial perspective for a period of time, cyclically. I expect volatility, but in the next 3 to 5 years, 0 to 3 years, 2025, between now and 2025, there's plenty of indicators for significant volatility events. But to me, as I said in the title of the stream, these charts, these pieces of confluence suggest the political decisions that have been made that manifested these charts. That we're directionally heading into a period of increased international liquidity conditions of the likes that haven't existed since January of 2008. You need a rounding top. It's been going up. It's been going up. Dollar price has been going up since 2008. 15 years. They haven't had a break on the price of the dollar relative to foreign fiat. Just up, 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 up. And finally, international conditions can get a break, and maybe we have a cyclical, maybe we have a lower low. Maybe political pressure says the U.S. wants the rest of the world to have finally a cyclical break in their financial activity. The pressure off the dollar. So I find that very interesting. Hope that helps, guys. Let's hit some comments. Tapsy. There will be volatility. I mean, look at commercial real estate and student loans. I mean, come on. Those are the two massive volatility shocks that are on our horizon. But they literally bailed out banks. What the fuck? I mean, literally, they bailed out larger dollar value bank bailouts 2023, this year, as compared to 2008. Okay. Well, not the bailout, but banks of size were much larger in 2023 that failed as compared to '08, and nothing happened. It was just papered over like it didn't happen at all because of survival. They themselves want the system to continue. And moral hazard was taken out back and shot in 2008, and now they understand. Now maybe we understand why Yellen says we will never see another financial crisis in our lifetime. Yeah, because it's a completely artificial managed liquidity environment. Liquidity. How did they resolve the banking issue? They provided liquidity. That's what this chart is. Artificial liquidity management. So they're cutting rates, tightening rates, which is suppressing credit, which is decreasing liquidity. But this relatively elevated level is maintaining financial liquidity. Now, there's a big difference between the real economy and the financial economy. If you guys are invested in the financial economy here, this is not an equities market. This is not the same thing as Walmart, as dependent on the real economy. Now, bear in mind, I'm pretty sure Walmart could get whatever kind of loans and financial financing it wants at whatever rate it wants. So they're not really affected by the real economy as compared to like a mom and pop that's probably going to get 7, 8, 9% or whatever the hell they're going to get, and that's horrible. So yeah, obviously there's the morality of what's going on. But the real economy is not the financial economy. You are invested in the financial economy. Therefore, you look at data that tells you information about the status of the financial economy. Don't forget that. So the headlines you see about the real economy are significant because the financial economy and the real economy are connected by knock-on effects. But the conditions in the financial economy are not the conditions in the real economy. Don't forget that. Talman, good day. Risky Crypto, good morning. Ding Ding, good weekend. Joe, going back to 2006, consumer bankruptcy filings are still at an all-time low. All right. Now, bear in mind that's the real economy, but that is interesting. And always remember the knock-on effects between real economy and financial. But that's meaningful. So, this whole talk of recession, it's irrelevant from a financial economy standpoint. If there's a complete recession and there's 10%, 20% unemployment, but bankruptcies are completely absolved and liquidity is provided and there's lending between banks, the repo market is flush. I mean, literally, the Fed basically is still in the repo market if need be. And liquidity is flowing, you're going to see financial assets do very well in a relatively rough and difficult real economic situation with large unemployment. And that's the disparity phenomena that everyone talks about. So just distinguish between the two. Zoidberg, pleasure. Paul, good morning. Austin, hey Captain, I have a position in Curb but looking to expand my cash flow crypto enterprise. What do you assess to investigate? What cash flow assets? Well, diversification is important just in case of narrative invalidation. You don't want to be 100% concentrated, never go all in, never spread too thin. So diversification doesn't necessarily mean outperformance. Just remember, the general public sells winners to buy losers, and that's the concept of diversification. But you should be doing the opposite. You should be selling losers and concentrating into winners. And that's kind of what Michael Saylor talks about. There is no second best, and it's true in many regards. Bitcoin is an allocation that has really nothing, no peer in many regards. But it doesn't have cash flow. So it has different properties that force you to diversify, even though there is no second best in many regards. So I agree with him in many regards. He's quite reasonable most of the time when he speaks. So you don't have to necessarily diversify into alternative cash flow. You can stay within the Ethereum mainnet or a balancer. Tapioca still hasn't been released. We'll see what kind of cash flow is available there. But Bunny is interesting from a Uniswap perspective. And frankly, that's the short list. Everything else is marginal. Marginal with regard to significance in the crypto space. Because you're either allocating towards the leaders, and everyone speculates that, oh, this small, yeah, every once in a while you get the small asset that becomes a market leader. But market leaders remain market leaders. The concept of momentum. Ongoing disruptions are very rarely ever disrupted. It takes years and structural change and like a real revolution and innovation. You think someone's going to come along and disrupt an AMM that has all this sentiment and emotional attachment and convenience? That's why so many folks use Uniswap. It's simple, it's the first, it has the momentum. That's why Bitcoin is what it is in many regards. So complicated question because, follow the rules. Never go all in, never spread too thin. Sell losers, buy winners, which creates concentration. And don't forget your cash and cash management. And we had videos earlier this week or late last week about cash. What is cash? That's another story. Balance the budget. Watch debts because the real economy, we're engaging in the financial economy, but we live in the real economy. So we have to be careful with regard to debt servicing, unemployment risk, so on and so forth. So, Austin, still looking at Timeless? Let's put it this way. No. I looked at Timeless. I have Timeless. I have the position. I don't constantly look at the market for what can I buy? What can I allocate to? I have learned over the years, I either take a position, I have a position, and that's it. I'm not like, oh, I need to buy more. I don't have enough. I don't have that emotion anymore. I have a position size that I took, and I'm quite satisfied with it. I have position sizes and structure, like a construction, like a building. The portfolio is broken down into percents and chunks, and they're not going to change. The structure isn't going to change unless something significantly changes with regard to market behavior or the narrative that's prevailing in the markets about what these systems are doing. So right now, I took that position quite a while ago. That's a bunny position, and that's that. So I think what I take two positions in 2023. I took the Aura position really early in 23, or was that late 22? I don't remember. Maybe you guys remember from Discord. And I took the bunny position. What did I size those positions at? They're relatively small. I think Aura was like 5, 6, 7% at the time, and then Bunny, I think, was like 1 or 2% of the portfolio. So there is no mathematical equation how to size your positions. This is all subjective, meaning you have to make choices that will affect how well you do. And you can only measure how well you do from the future looking back. And hope that helps. Dan, good morning. One Curious View, Buddy Lawrence, hey Cap and people, much a pleasure. Listen, it's July 4th weekend. No stream on Monday. Relax. Get away from the markets, but follow the data. The data is always interesting. I'm always looking at charts and price activity and social media, but don't sit in front of the computer. Get away, decompress and digest and assimilate all this data. Maybe watch a couple of my streams to rehash these not abstract concepts, but philosophical concepts about how to think about these things and find your comfort. The only way to outperform is to be comfortable with what you built and what you own. And that really, you have to cure the anxiety. That's the biggest burden with what we do. So find position sizes and be comfortable with what you size. Be comfortable with the positions you own. And only if something is invalidated do you get rid of it. On Discord I mentioned earlier that the aura position was relocked because it has no indication that the narrative is invalidated. Decreasing cash flow, but it actually bumped up. I think it was 3 and change cents. We were at 2 and 2.7, 2.6 or whatever it was. And that's just part of volatility. If anything, expansion to Arbitrum, everything is consistent with the narrative that exists for the protocol. There's nothing that's invalidated about it. So the position stands. Even though maybe I wanted the capital. I wanted that dollar-denominated capital. But I chose to override the emotion for consumption for principles that I've attained over the years on how to manage holding versus liquidation. But it's not holding. Please don't get me started on the concept of hodling. And there's nothing about cognitive dissonance. What's a good phrase? Like just ignoring, like blind faith. I'm not a fan of blind faith or just forgetting about it. Oh, just forget about it. The concept of hodling I find quite unappealing. It's the antithesis of what we just did this stream, a rigorous evaluation, a rigorous methodology, a rigorous philosophy. Find the philosophy, then you'll find your comfort. 24 people in the stream, 8 likes. I appreciate all of you. Thank you for always joining through this remarkable bear, bullish, whatever the hell kind of market this has been over the last couple of years. But I appreciate all of you. I think we'll have a good time in the next between now and the next whatever cycle of liquidity. And you all made it. The important thing is to survive. Tell everyone to subscribe. Friday, June 30th at 12:14 p.m. You know the deal. After party on Discord in the comments, in the description below for the most rational community in the entire crypto space. I will catch you next time.